started. Well, welcome everyone. This is Ed Ledford, FFP Insurance Services, and welcome to our podcast today. We are going to continue our program working through the IUL and how today the illustration is your friend. We've kind of upped it to the master's class level of this. We got a ton of positive feedback last week as Charles went through the basics of using the illustration to make the sale. And today we're going to continue, and just as a little preview, next week we will conclude the series on indexed universal life by bringing on board one of our top producers who's been using the IUL products extensively, and he's going to go through several case studies of how he's been using IUL in several different scenarios. So very exciting and very well received program so far. So, hey, Ira, you out there?
I am here, Ed. How you doing?
Good. Let's turn it over to you.
Yeah. Okay. Just a little bit of a recap here. Hopefully, most of you, I see most of the names. I know a lot of you were with us last week, but if you weren't, Charles was showing how he uses the National Life Group illustration in a point of sale, as a point of sale tool, really. And we got partway through it. Obviously, there's a lot to cover, but Charles basically he went through, and if you're familiar with the National Life illustration, there's a great graphics on there, as Charles says, pictures tell a story, right? But a great puzzle piece on how this product can be set up and funded to really produce a pool of money that can be used in many different ways, not just obviously death insurance, but you have your chronic illness, you have your critical illness, and you have a live too long solution. So went through that, but I think the most impactful thing you did last week, Charles, is you showed us how you spend a lot of time on the IRS limits, because as we all know, the IRS has set limits on how much money you can put into a permanent product. And in fact, that's the slide that I see you're showing right now, Charles. I think it's really powerful when you sit down with clients and start talking to them about how, just like their 401k, just like their IRA, the IRS limits how much you can put into these contracts. What that does is it really helps explain to your client that this is really about overfunding, okay? And quite honestly, you can only overfund to a point because the IRS wants their taxes. And if the money you're putting into this product, the IRS most likely will never see the taxes on this money when it comes, or the interest earnings when it comes out, if you do it the right way. So I think that's really powerful, Charles. I think it really helps. It gets your client away from how much does this cost and gets them into, well, how much can I put in, okay? And I think that's really important in getting your clients to understand that. As I talked in the kickoff of this, at FFP, we still kind of scratch our heads every once in a while. We'll get emails, texts, or calls saying, hey, how much does a $100,000 IUL on a 45 cost? Well, that's just not the right question, okay? How much can you put in, and how much death benefit do you need? Obviously, the lower the death benefit, the more cash. The closer you get to certainly the guideline level premium, the better these products are going to be if your intent is to have supplemental retirement income down the road. So anyway, we kind of got through that. Charles, I don't know if you want to add some things else as far as a recap before you continue on here.
Hey, one thing, if I can, Ira, for those of you out there, if you'd like to download a copy of the illustration so that you can see it right in front of you, Christy has posted that out in the chat box. So feel free to do that. Charles, over to you.
Yeah, I think great recap, Ira. Yeah, you said, I do want to paint that picture and go back just a little bit, just to summarize. You said it well, but I want to really drive home the points I'm trying to accomplish. That first part of the illustration, which Ira referred to as a puzzle pieces, the reason it's so important to go over that is because today's life insurance, you don't have to die to benefit. And it's so important. The illustration does such a good job of getting your clients into the conversation with you about what is an accelerated benefit and viewing life insurance in a much different way than it's ever been presented to them in the past, which really separates you from your competitors. And it's important during that process that you start to get a sense or a feel how important is death benefit protection, which can be accelerated for benefits, or what we're going to start talking about today, or am I more interested in tax advantages and life and cash accumulation? And what's that kind of, or the combination of the two? Because I want, and I left off the last presentation on what Ira just started off with, was these max limits, the IRS. But that's also where I started the conversation last week. Is it's way easier to sell a max funded product to federal guidelines than it is a minimum product. And so often we get caught up on quoting price. Well, the beauty of Indexed Universal Life, this is not a pricing product. This is a tax advantage product with a lot of living benefits. And that's the difference. You're not in the pricing business. So a lot of agents struggle with, a lot of times, I want to sell the best price to show my consumers the least expensive. Not in this product. You really want to show them the max that they can put in. And the way you do that, which gives you the freedom to spend more of their dollars, is show them more tax advantages. So I want you to write down, this is tax advantages. We're going to talk about tax advantages. The accelerated benefits are tax advantages. They allow me to accelerate my death benefit tax-free. And then today we're going to get into how the cash accumulation portion works. What's the most I can put into? And Ira reminded me last time, the IRS wants you to have a good thing. They want you to put money for your retirement. They want you to protect your family, your buy-sell agreements, whatever it might be, but they don't want you to have too much of a good thing, because as Ira stated, this is a product that they're probably never going to be able to tax you on. And that's what you're going to sell. So today, this is the limits. And it's also where I go back and I remind them, remember when I started the conversation and you saw the premium in this case of $900.33 a month. And I said, don't focus in on it. Last week, you'll learn that I said, don't focus in on it. I don't want you to get caught up in the numbers. I want you to understand the plan. So today we're going to understand the tax numbers. So this is where I kind of let my clients know not only what the federal limits are, but Ira, I let them know what it, in this situation for $500,000, what there is a minimum to get yourself insured and to buy all these benefits and accelerated benefits and the death benefit protection. In this case, that would be about $3,970 a year. So that gives you a wide range that you can put money into. And that's where, I use these guidelines right here to kind of, I let them off the hook. Now, if you're thinking $3,900 a year, a little over $300 a month is even more out of your budget, don't worry. I've never had any of my clients that see the usefulness of this type of product. Will make sure premium's not the issue. And if you're going to put anything to and I will structure a plan that's going to fit your needs. Okay. I just want you to understand a 45-year-old on $500,000 today, what the max they can put in. So this is an important tool because it gives you the freedom to write much larger cases. And I'm going to show you when you illustrate the max. My promise when I left last week's call was two things. I'm going to show you how to typically double, maybe triple the premium that you normally pick up on average, or double or triple the case size, which is also going to double or triple your income, or maybe 6 times it in that situation. I'll explain that later. So I'm now going to move past this page 10 and scroll through a lot of these definitions. This is stuff that was previously illustrated. It just reinforces, and we talked about the crediting histories and how important this is. But there was one last thing we talked about last time that I wanted to touch on, was the difference between guaranteed columns and current illustration rates. And I'm not going to recap that today, but last week, as you recall, the guaranteed columns we agreed wasn't at all what's occurring. In fact, when you read the statement in the definitions about guaranteed from the insurance company, this is likely not going to ever occur. They even say it in writing for your customer. So when you get down to the illustrations where we're going to focus today, I've already covered the fact that we're not even going to focus on what's not going to occur, even the insurance company. So we skip through the guaranteed and get to the current, which, by the way, has been illustrated out on this plan on the Swiss crediting method, which is on an average of 5.5%. So these aren't 8% illustrations. They're very realistic. So let's get down to the current illustration. Now, once again, now we're going to talk about how we really talk about the tax advantage of cash accumulation. And what I'm going to do here is go to line 1. Once again, we've got a 45-year-old to the very far right that's buying a $500,000 death benefit. And the IRS will allow this individual to dump in $10,804 on a lifetime basis without modifying and losing the tax treatment within the contract, making it a MEC. So as we move over to the current illustrator, which is the 5.5, then what you'll see is after year 1, you've paid in $10,804, you've received a $500,000 death benefit and all those other pieces, accelerated protection through the accelerated benefits. And out of that 10,800, 7,800 still in your accumulated money. That's your savings. That's money that you can access later on, tax advantaged, right? And unlike your other retirement plans or other tax advantaged deferred instruments, maybe like an annuity, there's not going to be a penalty by the federal government for distributions prior to age 59 and a half. That's what makes life insurance so powerful. It's the only place I know that you can put money tax deferred. As you accumulate money, access it without penalties, federal penalties prior to age 59 and a half. And that's when, like I stated before, most of your important financial decisions are going to be made that typically people end up borrowing to meet, like funding their kids' education or buying their first car or putting a roof on the home or just the daily things that come up in life. And in this plan, our goal is to kind of make you your own banker, to start allocating some of your money that when you're making financial decisions prior to 59 and a half, that you've got a pool of money in a plan like this that you've got the option to access on a tax favorable benefit. So if you've put in 10,804 and there's 7,807, then the actual cost or net cost of this plan is that $3,000 a year, about $250 a month, if you want to think about it that way. So another way at this point in your life at age 45. So another way of kind of saying that is the actual cost for the puzzle pieces and all that protection is very, very inexpensive. It's $250. And once we're over that $250 a month, roughly, then every dollar we're putting in this is going into money for yourself, tax advantage for those things that occur in life. Now, line 2, notice that in line 2, or when you're 46 or after the second year of your policy, now that 7,807 is 15,908. But notice in that second column next to it, the cash surrender value, there's $5,368. The cash surrender value is the money that you can start utilizing as being your own banker or money that you can withdraw that you have access to. So in year 1, there's 7,807. None of that's available. And that's what makes the plan work. And we talked about that last week about, seems like if you put money in the bank, the auto mechanics know when your car is going to break down. So, excuse me, I got somebody knocking on my door. Come back later. Sorry, apologize about that. So 7,807 is what is the money. It's in there. It's just not available. In year 2, there is money available. So out of your 15,000, you've got 5,000 available. So that difference, when people try to determine what's the surrender penalty in my policy, or what I call a watermark, That's where you can determine what the watermark or surrender penalty is. Go to the column where there's actually cash surrender value that becomes available. If you look at the difference between those two numbers are about $10,000. What the watermark is, and the reason I call it a watermark is until you get over the watermark, your money's in there earning and growing tax deferred, but it's not available. Once you're over the watermark, every dollar that gets added from that point is liquid. Now, it's not liquid like an ATM where you can pull it out and spend it unwisely. It actually forces you to wait 2 or 3 days or a week to get it, which is also why it works, right? Because it's not that ATM readily available. And that's why most people's 401ks work. Why do they work? Because I can't access it without penalties. So a lot of times that's all that your clients have funding their retirement. So what I'm trying to reinforce here is surrender penalties aren't a bad thing. I refer them to a watermark because they also decrease, they go down. And it's a way of the insurance company not charging additional fees up. It's how the insurance company defers the cost of, your commissions and that. And they let those that get in and out quickly pay the costs of those that get in it for the right reasons, and that's long-term solutions. So our first financial goal, and when I refer to the watermark, the reason I go over that watermark is this is where I find my annual premiums, or this is where I find other investments that they might have to fund these as an alternative method than a monthly bank draft. Because I make it a challenge. I make the watermark a challenge. So if I take my clients to line 2, they understand that once they're over that 10,000 watermark, now all that money is available. I say most of my clients' first financial goal with me is to get above the watermark. Because they want to know now from this point on, if I dump or give you, Charles, $10,000, $20,000, I want to dump it in somewhere earning, in this case, 5.5%. And have access to it, liquidity, because that doesn't exist out there. Nobody else is doing that but you, right? So I ask him, well, do you got other underperforming assets that you've never touched? You haven't touched in the last 4 or 5 years that's earmarked for long term. A lot of my clients will dump in a minimum of 10,000 of their money that they're not going to need right now or haven't used, and they're far to get over the watermark. So this gets the conversation going about how quickly do you and your family, is that something we could get over today, or how quickly would it take you, do you think, set aside 10,000 to get over the watermark? And let's break that down monthly, and if that's $833 a month, is it $300 a month? That's where your client, if they don't have a lump sum, will say, no, I think we could probably allocate $500 a month to this. Well, you just found a $500 monthly target, right? Instead of coming in there and telling them what the minimum is or quoting a target premium, they will tell you what their goal is because they're buying their dollars now. That $500 a month represents dollars in their cash value. Now, that might be reducing the amount they're putting in above matching to a 401k. We can all have courses on finding the money. But the first financial goal I want my clients to get to is get over your watermark. And I want them to tell me how long they think it's going to take them to get there, because it's our goal. I make it my goal as their financial to get over the watermark as quickly as possible. Now, I'm not going to go down every other column and play the what if situation, because truly the only thing guaranteed in this product is none of these numbers are going to match. Guaranteed column's not going to match because they're not playing the guaranteed column doesn't even match because they're not charging the extra premiums right now to stay solvent. And we're not always going to pay 5.5. So I don't get caught up in trying to overwhelm my clients. I want to get them over 10,000. Now, I will point out if it does average 5.5%, which I think is very realistic, we can go back to the crediting histories. That what's interesting about this plan is, and typically on a max funded plan in year 13, they got to return a premium. If they got out in 13 years, there's still a little bit of a surrender charge, and not in this situation, but they've got a return of premium. Let me point that out. In year 10, if they max funded it, they put in 108,000. They got 96, almost return of premium, and they had $500,000 protection with accelerated benefits. But in year 13, add another 33,000 to 108, and you'll get 142, right? Or what's in there in year 13? 144. So you tell me, what kind of a sell is that? In worst case scenario, in 13 years, you don't like me anymore, I'll give you all your money back. And you had all the protection within this product, but nobody's going to do that, right? Nobody's going to walk away. But, you know, for you, I bring this only up. Some of you have sold a return of premium term. Well, you typically got there's not a return of premium they're not going to wait 20 or 30 years on, right? This will smoke this product, right? It's a concept is all it is. So if you sell return of premium, you're selling the wrong product. This is the product that is way better, right? When you understand it. And so later on in life, you'll just see it's just a lot more money at 65, an additional $315,000 for retirement, or money to get that second home near your kids because they're going to all move away from you and all that. You're going to need a down payment, whatever it is. You want an RV. I'm sure you can get a lot of them at a really good rate right now with gas prices. You know, whatever that buying decision that you want to be, you're going to be the banker by 315,000. You're not going to have some 25-year-old sitting across the desk when you're 70-year-old seeing if you credit qualified to get their money, right? You're already credit qualified on yourself, right? And that's the fun I have with this. And we can run numbers out, but I sell concepts. I don't sell numbers. So I'm not going to overwhelm you with how much money you got in this first scenario. But what I want you to catch at the very end of this is that it is the tax advantages. And you can put together, it's about getting out of debt while you're 45, 50, getting ahead of things. So you're not always borrowing at 18% while you're trying to save at your 401k right now, minus 11%. Okay. You're out there continually to put guaranteed money aside into a plan that's very reasonable, that makes sure if you die too soon, that your kids' educational dreams are self-completed off your legacy. And that if I don't die too soon, and I have the unfortunate situation of having one of those other puzzle pieces take place, that I'm spending the insurance company's money, not my wife's retirement money or my additional cash value for their college education, those types of things. So that's the power of this product. And this is also where you find the premiums by giving them a goal of getting over the watermark. Now, there's one last thing that you don't share with your client as part of the illustrations you can include. It says for home office use only. I guess I'm the home office because I use this for myself quite a bit. And in here, what you'll find is everything that was on that previous page. We started over here, what the minimum premiums are, the maximum premiums, but I go to the target premium because that's how I'm paid, right? See, that's where I made you guys a guarantee of, you know, I was going to show you a double or triple way to make double or triple your income. And here's where I want to summarize. And this is the ranges that they can pay within this product. And if they can't afford the 300 and something a month to get to the minimum of this, we'll sell them a 250,000 max funded if that's what they want. But let's go back. The very end of my presentation, I'll ask them, Ed, Ira, what's more important to you guys? Joe, Mary, whatever they are at the kitchen table. I ask them both. What are you more interested in? Are you more impressed, or are the accelerated benefits and the death benefit protection more important to you? I'll just ask you, Ira, in this situation. Ira, is the death benefit protection more important to you, or are you more interested in kind of becoming the own banker, the tax advantages of the cash accumulation? If you had to weight one higher than the other, which would it be?
I think I'm more focused on that chronic illness rider and maybe the critical illness. I think that's more of a concern to me than the accumulation. So they're both important, but I think I focus more on the chronic and critical.
So in other words, on these chronic and illness back in the previous pages, Ira, let's say at age 65, instead of having 6,805 in a month for a chronic illness like long-term care, if that number was closer to 10 or 12, you'd be more comfortable.
The more the better.
And if you didn't have to use it, thank God, or you didn't have one of those critical illnesses, I'd be delivering $1 million tax-free to your spouse, or that money that you're setting aside for that's going to go to your legacy. Is that cool? Well, Ed, what about yourself?
Well, I'm all about the retirement income.
Okay.
I need that second house near the grandkids.
Great. So what we'll do is I think I can find a way to give both. And I'm glad you guys went different ways and we didn't rehearse that, right? Because right now, if Ed and Ira told me that they've got a CD or they've got something set aside right now that they could get over the watermark, I can dump in $10,000 or whatever that amount of money is to get over the watermark, can't I? And then in this situation, instead of paying $900 a month, I can at $900 a month, given $500,000 by getting over it wouldn't quite give me the watermark to change it, but I can then increase that death benefit to a higher amount, or depending on how much money they're going to dump in, I can then focus in on more of the mid-range premiums. I'm not focusing right now with IRA on trying to mech it, not $1 from meching it. I've got a range somewhere in the middle. So in other words, by running a higher premium, if I was talking at 900 and they tell me I can do 900, well, then I can get them for 700 a month, at least a minimum to get them started with an idea they're going to dump more money in. I can get them double the face amount. Or in Ed's situation, I might then find a happy medium. I might rerun this out at 750,000. I'm still going to max fund it when I run the illustration because I need to do that. Ed's going to like those numbers better and better. And Ira's going to like those numbers even better. And that will give me an opportunity of then talking about the higher watermark. Well, how long? Now that's going to increase the watermark at 750,000 to about 15,000. So how long? You guys already got the money to get there. Maybe you got some other assets that we can do both. So it's because, once again, if you don't get caught up on rate of return and premium and they're understanding the concept and the illustration, then our role as financial advisors is to help them to find the money within their other assets to accomplish what they want, what's best for their family. We're paid to find the money. We're not paid to sell insurance. We're paid as agents to be the solution for clients to go out and come to us to find something they really love and make it happen. That's why we at FFP have Christy and her team that you can send in a case. You don't want to run a case by us, or that's the purpose of these calls. So that's what I want to get at. And the last but not least, what's cool about National Life in this scenario, and I go back to this last page where I was at, the target premium in this case is what you're paid on. So if whether they max fund it or minimum fund it, I'm going to make $8,405. Now, if they only pay $4,000 a year, what's cool about if they didn't go to the max fund, they paid a little bit over the minimum to get started. I'm still going to, at $4,000 a year, get the full target comp. National Life pays you that target on a rolling basis till you get over it. So 2 years and 3 or 2 years or 4 months, I'm going to get a much larger commission because I showed a much bigger plan around max funding. If they go in immediately for $10,000, you're only going to get the regular comp up to $8,400. Don't get mad. Don't call Christy going, where's my other? Your paid target premium is how you're compensated. And they've got a rolling target premium to get there if you don't get it in the first year, which is really cool. Now, to make Ed and Ira happy, just because I explained this in a different way, they decided they were going to agree on the 750. My target comp, just by not running numbers, but sharing concepts, increased my target compensation to over 12 to 13,000. Because they're not buying premium, they're buying accelerated benefits and the protection for IRA and the cash accumulation to become their own banker for Ed. That's their money. That's not my money. Don't sell with your own checkbook. Now, let me show you another illustration I got from a very wise individual that's in my life, and that's a guy named Ed Ledford. I was going to delete his name on there, but I didn't know how to rerun the illustration. So, Ed, I'm gonna steal your thunder here and run.
That's all good.
A separate product called the Survivor product. That first product was called the Flex Life, right? Still an indexed UL, but a Survivor product can be used in a lot of different ways. And what I love about what Ed did here is he took it's a second to die. It's a life insurance product that pays the death benefit on the second to die, but it'll let you put two individuals on there, including a mother and a son. So I call this kind of the juvenile policy alternative. It could be, instead of buying a juvenile policy, I'm going to show you how this is a little different approach, but it's very, very powerful, and how a mother at age 45 is going to put a plan on place that's shared on the life of both her and the son, which also helps her in her premium. And now the chances are she'll die first, but that's a way of leaving behind a pretty powerful death benefit, as you'll see here. Now, we've went through the illustration, so I'm not going to go through all these powerful pieces and all the crediting options and all of that. Okay, it's a little different, but look at the guidelines. Here they are again. Now, in this situation, we're not going to run at max. The client has made it clear that she's got $200 a month. She was going to normally buy a policy from Ed for about $30 to $50 a month for her child. And Ed said, let's show you something way more powerful. And it's a little more premium, but I think you're going to really like it. Let me show you. So these are the guidelines. We're not going to run at max target or max fund in this situation, nor are we going to run at the minimum amount, which is only $714 per year. Okay. But we're going to put them $2,400 per year in. So I'll slide down, bear with me, go to this arrow to the right, speed it up. Still ran at the 5.5%. We get past the guaranteed because we know that's guaranteed not to happen. And we get down here and we go to the illustrated values here. Now, see in year one, so what this Ed proposed in this situation was, let's put $200 a month in or $2,400 into a plan that, as you'll see, is weighted on her age and the newborn's age, 0, year one, newborn. Okay, so I'm going to put $200 a month into this plan and go to the right. The accumulated value after the first year is out of that $2,400, $2,000's in my savings, in my bank, right? Year two, there's $4,109, $600's in my bank. So the watermark for this $250,000 death benefit, the watermark or the surrender penalty is about $3,500. So I would have talked to her about dumping in $3,500 up front to get over the watermark, but it doesn't matter. I just want to stress out how to calculate the watermark. Notice there's a watermark because it goes to 0 after the 10th year. All of the money's available. That's why it's a decreasing surrender charge, but it sounds so punitive. Watermark is better, right? So Ed ran this out. So let's pay till your child reaches the age of 17. Man, you're going to the graduation. He's got the cap, throws it in the air. And in this situation, stop paying. Wouldn't it be nice? Now you've had $250,000 worth of protection on both the second to die. But after the 17th year, notice in the 18th year, Ed wasn't max funding. This wasn't designed to pay the kid's education, but you want a child to have a little bit of money, $400 a month spending money at college, to go out with his buddies, have a bowling night, do whatever and enjoy college. Well, what we're going to do now is we're going to, instead of paying, we're going to stop paying and we're going to take $5,000 a year out of that plan through college. So it totals, because after the 20th year, you've paid in $43,200, and as after a second year in college, you've taken out $10,000. So you've really only put in $33,000. Oh my gosh, you got $69,000 in your account, but you've only paid in really now net 33, right? So the next 2 years, his junior and senior year, takes that 5,000 out and still has 77,000. Well, mom still has 77,000, which is what makes it work, right? Because the kid doesn't have 77,000, right? And then the mom just kind of keeps things going, the parent in this place, and had an idea. Wouldn't it be nice? I haven't made a premium since my child graduated, but what about age 35? He's probably going to grow up, maybe married now, hopefully. Maybe I'm thinking about my first child or grandchild or their first home. Whatever the situation might be, they're going to really appreciate what I've done for that child now. So I'm going to take out notice in year 35, when the child is now turning 35. I'm about age 80. Now, how I bought this when I was 45, I'm about age 80. How cool is it that I'm going to be able to take out 30,000? I could take out a lot more than that. There's 160,000 in there, but I'm going to take 130,000 out for a loan right now. And there is a loan that we didn't pay back, but I could go through this a little further, but in this case, we can take out that $30,000. That's a gift to the child. And this is showing we never even put $1 back against a loan. And that's why you're seeing a difference between the accumulated value and the cash value. But I don't want you to get caught up in that. I want you to understand the story, because people don't buy products, they buy stories. And that's what we're talking about. And they buy pictures. Picture says 1,000 words, right? I want them to catch on the story. So I paid in 43,000, and I've taken out, by the time I'm age 80, the 20,000 previously for my child's education, and then the 30,000 maybe for their first home. $50,000 I've taken out more than I've paid in. And if I die first, the death benefit doesn't pay, but my child now has a plan with 128,000 in it after receiving a down payment for their home, the great memories of college, and I'm still going to have, and if that child dies too soon, at that point, there's 444,000 protection, and he's never made one payment on this plan. He's only seen 50,000 coming out. That's a powerful story. That's a concept, and that's the power of an illustration if explained the right way. And that's the survivor product. That's why you call FFP when you need help. Christy is very well equipped with her team to be able to put these illustrations together. Ed, Ira, myself, any of us can do this. Our team can do this. And don't forget, you can always email us at cwc@ffpis.com. When you write the apps, you'll submit it through nb@ffpis.com, or if you do an e-app, it's going to come to them automatically because you're going to use our website. And with that, I don't want to ruin the story. So I'm going to turn it back over to you guys, Ed, Ira, and let you guys close this thing out. But I really hope you got a lot out of this. What Ed refers, and makes me feel pretty like a professor, the master's version or the master's series of how to sell the indexed UL. So with that, Professor Durfee is turning it back over to you guys.
Thanks, Charles. What a great job. And I hope you all enjoy it. I mean, this obviously, we've got case studies that can go on forever. If you're following that last survivorship, by the way, if you looked at the cash surrender value, that would be net of the loans, what they still had. So there was still a ton of death benefit. There was still a ton of cash, and it continues to grow out there. One couple of caveats on that plan, though. There is no critical chronic benefit at the front end of this, but after the first person dies, so when mom dies, it does kick in critical chronic for the second surviving kids. So in midlife, in theory, they certainly have a chance for that critical chronic benefit at the end. Charles, thank you so much. This really is powerful stuff. As I mentioned, next week, next Thursday, same time, same place, we're going to have General Bernie, excuse me, we're going to have the General on to talk about how he is using indexed universal life products in several different scenarios. And he's really having his best year ever. Had his best year last year, and he's going to have a better year this year, using this to help clients with their needs and saving plans that are troubled. So please join us then. Ira, anything to add?
No, I think we're about out of time, but I mean, just to go back, Charles, I love how you use the max IRS limits and the watermark to educate your clients and quite honestly challenge them to try to hit the max. Don't we all, if we're able to, love to max out whatever the IRS will let us do for benefit? That's always a goal. So I really think that's a genius way to approach this product and really help the client understand it and get the most out of it. So good stuff.
Good stuff is right. All right, everybody. Well, listen, good selling this week, and we'll see you next week with Coffee with Closers.
All right.
Take care, everybody.
Guys.